Welcome everybody to the Fundability Report. It's Wednesday, 3:50 Mountain Time. Let's get into it. What's happening in the current mortgage market? The lenders are spooked because the high risk defaults, they're calling the canary in the coal mine for the mortgage market. Now, remember, we had 2008 is still fresh in a lot of our minds, even though it was literally 14 years ago. And so there are institutions, especially the Chases, the top tier banks, these institutions have a long institutional memory. And so there are mortgage defaults are climbing in some of the C and D and the B and C paper, right? So a quick definition for those of us who aren't in the mortgage marketplace. A paper is basically that 740 credit score. There's AA paper, AAA paper. So the likelihood of payment to term, even 30 years before it's refinanced out, is very high, right? Well, what's interesting is every one of these, a B paper is where there might be a ding. Some collection accounts had to be paid off. They're recent, but they got paid off, right? Moving into C and D paper means that there are higher interest rates that correspond with worse credit. So the early payment defaults is defined as at least 2 missed payments within the first 6 months of a mortgage. Not at all, but within the first 6 months of a mortgage, meaning something has happened, or their paperwork or the underwriting was a little bit catty in order for them to miss 2 payments of their first 6 payments. It's even more pronounced in the FHA mortgage place, which are all guaranteed by the federal government, and especially with scores of 550 or less. So there are some people who are getting scores or getting mortgages with very, very low FICO scores. And so we want to make sure that we're aware that if you are in the mortgage space, I'm sure you're being kept very aware of these trends. If you're in the borrower space, then we want to make sure that you do everything in your power to stay up to date with your mortgage, those mortgages, because that's like the bellwether. If you go 30 days late on a credit card, that's one thing. You go 30 days late on a mortgage, losing your primary residence, putting that at risk, is weighted far heavier by all lenders in the future. So the fundability issue here is that whatever it takes, keep those mortgage payments in play. Now, our second line here has also to do with mortgages. So last week, if you've been following me at all, if you've been paying attention, you're part of our tribe, or you watch the weekend update or these updates. That was an SNL reference, the weekend update. But what we've found is that we've been saying that there are FICO scores and FICO scores. Well, last week, the mothership, the umbrella organization that ensures the underwriting criteria for FHA, Fannie Mae, Freddie Mac, etc., they basically authorized the use of Vantage mortgage scores. Vantage mortgage scores. So when we talk about FICO and FICO, I'm going to be a little more careful because I always define FICO scores as scores that lenders do not use in the approval process. Well, let's be very clear and listen all the way through this process, because the battery of exams that Fannie, Freddie, FHA, Veterans Administration, VA loans put through the Vantage score, they pass muster and will accept those scores. Here's what's interesting. they still left it to the lenders to decide which score to use. So basically they said, you can draw from Vantage scores, Vantage mortgage scores as part of the underwriting process. But there are very few to none lenders that are currently using the Vantage score as part of their underwriting process, because mortgage companies, mortgage brokers, et cetera, loan officers use mortgage credit reports, and that's LandSafe, Credco. There's a dozen really popular mortgage credit reports that mortgage brokers can use to evaluate. And remember that while bankruptcies are still listed on consumer credit reports, Experian, TransUnion, Equifax, though they no longer carry judgments and liens. So these mortgage credit reports that Credco, LandSafe, et cetera, Innovus, all they pull consumer credit bureau data, Experian, TransUnion, Equifax, and they go to LexisNexis and pick up the liens and judgments so that they're all included in a mortgage credit report. Well, that mortgage credit report would also currently downloads FICO scores. So you got this mortgage credit report is pulling data from FICO, from Experian, TransUnion, Equifax, and from LexisNexis, and shaping it into a mortgage credit report and then giving it to the lenders, the mortgage lenders. They're now saying you can now draw into your metrics the Vantage score of mortgage credit scores. The interesting thing is that most lenders are already using these and the LandSafes, Credcos, et cetera. And so it's not mortgage companies. The mortgage lenders are not changing. It would have to be the mortgage credit reporting agencies that are collecting all this data and giving that data in the form of mortgage credit reports. Those are they would onboard a Vantage score product to include in their data. And then every one of the mortgage brokers who subscribe to those mortgage credit reports would have to change their internal check boxes to authorize or determine the rate and term using Vantage score. So that Fannie and Freddie okayed it is one thing. That the entire industry is going to onboard Vantage score mortgage scores, that's going to take some time to adopt. And so, and I'm currently not aware, doesn't mean it's not happening, but I am currently unaware through all my FICO contacts, lender underwriting contacts, I'm unaware of somebody who's been waiting in the wings to be able to, that's a trusted mortgage credit reporting, credit report wholesaler. I don't know any of them that are in the wings going, we're ready, we've got a Vantage score, right? So just watch for that. And I have been changing my language to saying it's still a bait and switch when Credit Karma uses Vantage score and then you press the apply now button, and when you hit submit for your application, they use a FICO score. That's still a bait and switch. Nothing changes there. Vantage score is not used in those lending decisions for unsecured credit cards, credit lines, et cetera, especially from banks. That is still not true. The only place that's changed so far is, that it's available, hasn't even changed yet. So far that it's available is with mortgages. So that takes us to our final, is that there are 5 trends helping the unbanked gather financial services. And so let's go through, I'd like to go through each of those 5 really quickly, because we will be bringing these up more. I love the fact that more and more people, there are 50 million people who are unbanked. So it's about time the banks actually got on board. Instead of dissing that demographic, we're now learning to onboard. So the number 1 is people mostly bank through their smartphones. And so if they haven't made what's called a digital transformation, banks are losing out on the unbanked. Unbanked may not have a bank account, but they have cell phones and utilities and are paying bills through their cell phone. So we've got to mobile banking is shooting up in popularity, but for somebody to compete, they've got to have an online digital platform. Unbanked households turn to online payment services for core needs, paying their cell phone, paying their utilities, paying their rent, all those things. Almost half of households surveyed, 46+%, reported using online payment services in 2021. These are unbanked, people without a savings, a bank checking or savings. And when I say bank, I'm talking about credit unions as well. The technology has created a unique bankable moment. What that means is there have been a significant, almost half as many declines for the unbanked because borrower behavior data is more accessible in the underwriting process when they're using cell phone to access. We've talked about it before, but there is a correlation. It's not causative, but there's a correlation between how low and how frequently you let your a cell phone battery get to under 10% and the consistency of making on-time payments. So there's more data available to many of these unbanked persons. There's more data of them available, and they're expanding the alternative data model in the credit reporting and credit scoring. All of that is helping. And then, and some predatory financial services may be supplanted by fintech alternatives. So all of the finance companies, the things I scream about taking advantage of people, the payday check loans and et cetera, banks and fintechs are coming up with what they're calling low dollar loans, $500 or $1,000, and not charging 36%. But are encouraging them, you open up a checking account, do direct deposit in the checking account, and we'll loan you $200, $300, $500 at will. Radically different policy for the top 40 tier 1 and tier 2 banks. And so I applaud these moves, but the good news is they go from unbanked to banked, and they're putting in their paychecks as direct deposit that qualifies for having a little opportunity for a loan. And with buy now, pay later, those loans can be paid back in 2 to 6 payments. Everybody wins, low cost to the brand new burgeoning borrower market provided in these with these low cost loans from major banks. So I applaud it. It's been phenomenal. We'll be more on that later. And then gaps in the banked rate persist, and fintechs work to fill them. The fintechs are pushing harder than banks, but everybody it looks to be fishing out of this 50 million ocean of unbanked potential borrowers. And so we're going to watch over the course of the last 3 years since they started measuring it from 2018 to through 2021, the bank rate has gone from 25% down to just barely over 19%. Significant a significant move on getting more people into the system and making it easy for them to do so. This is Merrill Chandler, your guide to the fundable movement. And thank you for joining us. We'll see you next week, 3:45 here on the Fundability Report.